Okay, hello everyone. I'm here with Amy. Hello, Amy, from the Panoptic research team. This is an idea that Amy had, so we'll do a fun segment this week. Typically, we have options hours and also the trading show, but today we'll try to do it a bit more fun, a bit more educational, fact or fiction, debunking common myths about options. This is very exciting. I'm looking forward to it. Yeah, first of all, welcome, Amy. How are you doing today? Long time no
Hello.
see.
Yeah, well, yeah, a few hours or several ones. All good, all good. So I'm very excited for this one. I tried to gather like 20 questions, like myths more than questions that or misconceptions that we have about options, perpetual options, DeFi options, all of that. And so Guillaume doesn't know anything, doesn't know like any question. Like I didn't give him
Like
the
a
list.
test.
So it's gonna
I
be
don't
like
even know
full
what's gonna
live
happen.
interview test. So yeah.
Yeah, very excited. And before we go again, it's gonna be hopefully a lot of fun. You'll learn a lot. I'll try to cover a few key important points. But yeah, the first one is that we have the base competition going, and this is something that I also want to share because the I did a post where being a trader doesn't always help. Like the everyone in the top 10 was losing money. And then we can look at the ranking as well. It's changed a little bit, so people maybe reverted. The price action also was interesting over the overnight. But what I want to kind of showcase is that we have a trading commission going. We can actually see how people's performance are doing. The way that we compute the returns is shown here. We got prices for the best PNL, also prices for volume. A little bit more green here, so we have to go to number 8 before someone loses. Uh, oh, who's that guy? Seventh place. But yeah, the key point is that we're creating options. We can see who's benefiting the most. Steve here from the team as well. We can spy as well. I'm very excited. This one person, I did take a quick look. Um they are getting the most highest return, and the reason why is that they had a very bullish position, which is a short, a long perp. Price went up. They have 28% return on that position in 18 hours. Very good. So what we're going to see is likely the biggest winners will be these directional bets and those that have been kind of moving with the market. Those, let's go Steve as well. And those will likely get the biggest wins and the biggest losses. Again, it's a bit a game of chance. Here, there's another one that is doing well, which is Steve's, but this one also is pretty bullish. Both of them are selling options, short puts. Steve is earning some premium, but also earning some fees as well. I would like to see how this comes back to be positive. But yes, at the end of the day, this is going to be very fun. I'm looking forward to it. So again, this is the first time we can give updates. Maybe we'll do this a bit more on Friday. But yeah, otherwise, go trade on base. This is the competition that happens on base. We will also have points for those that participate. We have trading on mainnet as well that happens. We have points there as well. The gas is cheap. I mean, Pectra came in, and I think the gas should be even lower because they have increased the blobs. So technically, there should be even more space. So yeah, maybe gas would be even be cheaper on mainnet. Very excited about base Unichain as well, and also mainnet. Maybe more change will come, but yeah, this is where we're at. And yeah, maybe we'll hand it off to how do we do this? No, this is too much. We'll hand it off to Amy, and then introduce the questions and the myth that again I'll have to
Yeah,
debunk or maybe fold into an embrace. We'll see.
yeah, for sure. Okay, let's begin. Are you ready?
Let's do it.
All right. So the first question is DeFi options cannot compete because they lack order book data and market makers. So that's actually what we were talking about like a
Just
few
now,
minutes ago.
yeah, I was on
Yeah, just
a
now.
listening to another Twitter space. Folks from Monad organized it, but this was the endless debate: AMMs versus order book or clubs. Why not? So two people from a club protocol, two people from AMM protocol. We've seen this happen pretty often. But yes, uh, I'm of course partial to AMMs, but yeah, typically to address this question of AMMs of DeFi options versus order books, I think my view is that the order book model can only scale so much. You have in TradFi, S&P 500, Amazon, Apple, Tesla, all of those extremely traded underlyings. They have a very liquid options market. A market maker on the option side, they don't have to order one book to manage one book, but they have to manage hundreds of them for expiries, for strikes. So unless there's a large demand for buying Tesla calls, for instance, it's hard to make money because you have to manage a lot of different options, and someone can certainly kind of pick you off or exploit you. So if there's enough participants, enough trading, that's how order books shine the most and then the brightest with large stocks, ETFs, even the IBIT options is fairly liquid, and this works. No questions about it. But if you go down the chain of stocks, even again TradFi, and you go to could be IBM, could be a new stock that IPO'd. Coinbase is better, but it's less liquid than IBIT because of the difficulty to market make. And if you go to on the long tail of assets, again, very recent stocks, those that have been around that aren't like Ford to some extent has a lot of trading, but it's not perfect. It's not as good as Tesla. Two car companies, but then one of them has a lot more demand. So the limitations of the order books is that it's hard to manage, hard to do it over hundreds of markets, and hard to do this consistently with everything that's going on. A single price move means you have a million data points almost to update to fit your whole kind of order or surface. So DeFi options is suffering from the same problem if used on low book times 100, because you have to manage multiple strikes, multiple expiries, but changing these orders, changing the bid ask is costly. It costs gas. And of course, ETH BTC, you could have a lot of efficiencies and you could still see this work on the order book model. But the medium to long tail of asset, even the after ETH BTC, I doubt there's any other market that could exist because unless you're a app chain or unless you're in a cheap chain, and it doesn't never anything cheap, I guess, but you have to respond to every price move with hundreds of transactions that you have to pay for with gas. And that's why order books and options don't quite scale. You can have order books for perps, order books for maybe spot, order books for options. I don't think it's never going to scale because of that multi-dimensional nature of market making. And that's why DeFi options, again, of course, Panoptic, we think we have found a way to solve this inefficiency where you don't even have to price the underlyings. You don't even have to change the bid ask. It's all done automatically. That is kind of the medium to long term to even extremely short tail asset that could be made into a market, an options market very easily.
Mm, yeah. Do you think we can convert a DEX pool to an order book structure?
It depends. A lot of what people say is that, oh yes, concentrated liquidity, you still have bins and you can put the order there. Maybe the not the flaw is that orders in TradFi markets or order books, when they are executed, they're gone.
Mm,
Someone buys, there's no, the open interest decreases or whatnot, but there's no more of that order existing. And AMM slash index, it moves across, it's still existing, can move back and forth and back and forth. So people see this as a bug, meaning, hey, I want to range order, I want to be able to kind of not buy it again.
yeah.
However, I see this as a feature because now you don't have to worry about these orders that have been picked off, quote unquote, because oh my god, it moved through because it's still there. If the price moves, if it's a single price like candlewick, you can still get back to your initial assets. And if you want to construct a real order book using DEX positions, you'll have to manually burn them, manually remove that liquidity if you want to replicate the same feature set. If not, you're stuck more or less with this kind of perpetual order that never gets expires. You can say, oh, it's such a big problem that all of my buddies doing market making in TradFi cannot even understand this. So let's try to create an order book on chain. Again, Panoptic's view is that it's how it works. We have to embrace these differences. And yes, now we say it's an advantage. No need to manage the order book. No need to kill the orders. No need to worry about getting picked off because that order still exists. There's nothing that is destroyed
Yeah.
by the price moving through it.
All right. Perfect. Next question. So, options in DeFi aren't real. Traditional finance will always be superior in derivatives.
They aren't real. I don't know. I think the we will see how spicy this whole things get, but the use case for option may not be there, or a lot of what people say is that yes, leverage is important and degens want to use leverage. They go on perp exchanges and hit the 100x max leverage button, and this is how they get their fix for leverage. They don't need options. 100x perps is even better in most cases. And I would say that if you're a pure speculator and you want to do a 5 minute bet, maybe few hours bet, which is can I go up? I'll go back to sleep. I get liquidated or I make 100x. This is a good deal, and it's one way of using perp dexes.
Yeah.
The demand for options, I would say, is so essential, so intrinsic to any risk management strategy that
Mm,
you don't even need unless you have the options, you don't know what you have, you don't know what you're missing. And
mm,
as again protocol like Panoptic get traction and you can now trade liquid options on could be E2SEC first, but any market, then you can see how risk management trades can be made. You can still have leverage. Again, I would concede that 100x perps could be good deal for many users, but if you want to do 5x leverage, 10x leverage, or maybe 1x leverage, but then with some exposure to the upside that is unlimited but no risk of liquidations. That's a different way to trade. Then options have this kind of attractiveness. Again, there's a lot
yeah,
of gray. It's not binary black and white, which is what you have in
yeah, of
perps.
course.
And you can ask a fund, a bank, a liquid fund, do you want to hedge on binary events or you want to hedge with a continuous spectrum, which is you can be a little bit wrong, a lot wrong, but then there's a transition. It's not on and off.
Yeah, for sure. I like that. I like the gray area. Okay. Third one. The Black Scholes model gives fair prices.
So yeah, this is for those that are knowledgeable of options. It's just a model. I don't say it's fair locally. Let's put it that way. Most people agree this is, in theory, the best way to price options. The simplicity of it makes it so much widely used. There's one parameter, which is the implied volatility. A lot of the extensions of improvements on Black-Scholes add either a second parameter or add still morphs this volatility onto a different one, which kind of can be thought as the same model, just a slightly different input parameter. But yes, the simplicity, the applicability, the local nature of Black-Scholes makes it very useful. And the IV now is not constant, it's price dependent or time dependent. There's two dimensions, it's a surface. But even there, each local region is fairly well defined within that kind of IV that you chose. So I would say that it's a, and maybe I'll return the question to you as well, because I haven't never studied this either in an academic setting, like in a class or anything. I don't know how people present this, but I would say that it's the best model we've got, even though it's not perfect.
Yeah, I mean, there's a reason why we haven't made another one since the 70s. So
And
it's
people have tried. And if you have a different parameter, I mean, the hopefully I won't butcher who did this, but I think it was Enrico Fermi, Italian physicist. He
Mm.
said, "Give me two parameters, and I'll fit any data to an elephant, and give me a third one, and I will make its trunk wiggle." Meaning
Oh,
that anything that has more than one parameter to an extent is so vast. You have so many parameters that you can fit anything to it. And just so that I don't insult or prove that I don't know about this, but yeah, let me see quickly who said that. Uh, but yeah, that's another one. The Black Shows so ubiquitous because of its yes, its simplicity. All right, it's John von Neumann that said this, but
oh
Enrico
yeah,
Fermi said it
the
too.
nuclear guy.
Yeah, Enrico Fermi, University of Chicago, my alma mater, made a nuclear pile right next to where I was working back in the day. But he was quoting another great physicist slash mathematician. But yeah, that's the
Okay,
idea. You want to have the simplest model possible and not go further than that.
for sure. All right. So we were talking about implied volatility. So the fourth question is implied volatility is less relevant in perpetual options.
Yeah, so implied volatility is a lot of what people are kind of considering when they are pricing options. Uh, the implied nature means that it's forward looking.
Yeah.
In
Forecast.
traditional options drag shows, you look at what it is in the future, and this uncertainty means there is less that it's known, and typically that means that the IV is higher than realized or what looked at the past price action. So I would say that the implied volatility is billions of dollars have been made or lost on pricing the implied volatility. As I mentioned, the surface is what you have to do, and that's why you have the essential, how essential it is. One parameter to fit, even that one parameter has so much depth to it that you can even go
Mm,
further down. That's TradFi, Black-Scholes, order book based options market making. The other way to do this is to think about the perpetual options model that we have at Panoptic, which is a slightly different way of thinking about volatility and pricing and premium. In a weird way, again, we're using Uniswap LP positions as the uh, option instrument, if you want, the actual object. Trades that happen when that position is in range generates fees. These fees are distributed to the seller or the LP. This is realized volatility. It's real trades that happened.
mm,
And to some extent, the perpetual options model that we use at Panoptic means that we price options on realized volatility, which seem a bit weird, but it's realized in Uniswap. There's no, what you get is what you get. Fees are fees. Here we do the same thing on Panoptic. So to some extent, the first order effect is that options pricing are not based on implied volatility, but rather on realized volatility, which is a weird
mm,
construct. The key point is that now if I sell an option, I get realized volatility fees. If someone buys the option from me, then they pay a bit more than realized. They create this divergence between realized and implied. And
mm,
currently, some traders are paying 50% more. The IV is 50% higher. Oh, the fees are 50% higher, actually. Then it's even worse than that. But the fees are 50% higher. That means that the IV now is priced above. And that is a new definition of IV, which is how much more than realized are you paying? If you go on a option chain, the IV is what it is, but then it would be a different column saying how much higher or lower is it than realized. In that case, it is just a different way of looking at it. Yeah,
for sure. What do you think we should change or add to the concept of perpetual options to make IV more relevant then?
I don't know. I don't know if we can change anything. Actually, we always adopt this very let's embrace the system a bit more than the try to change it. And
Mm,
yeah, there is not much more we can do than buyers setting the IV that they're willing to pay, and sellers
mhm.
kind of going where buyers are.
Right. Okay.
Oh,
Okay. Moving on. Yes. You want
maybe
to say
you can
something?
paste these questions in the chat, and then we can show them on screen
Yeah.
as well. It's in the
Yeah.
text.
Oh, I don't know if I have access to the chat though.
Oh,
Oh yeah, I
okay,
think I do. Oh no, no, I can't. I can't
that's
send
fine. All
any.
right, let's keep going.
Yeah, I mean, I'm gonna. I think I'm gonna write this all in like a presentation or something, or like an article, like a quick bite, and then we can publish it.
Yep,
Then maybe add some of your answers to that, like, okay, that's the myth and that's the reality, and just like have it in our blog. So that
yep,
I think I will do that eventually.
perfect.
All right, so where was I? Okay, so next one. Perpetual options are just synthetic replicas of traditional options.
Yeah, so
What's your
the it's a little bit this way. It's a weird, and again, it's a weird
mm,
construct. The this is getting a bit more advanced, but the way that perpetual options work, it's very similar to the perpetual futures model that exists in first BitMEX, but now many protocols, many exchanges. They shrunk the quarterly expiry instead of being every 3 months or 4 months. Now it's every hour that the futures expire. And if there is some more demand on the short side versus long side during that hour, that defines the funding rate. If it's 3 months, the price of the future is built into it, assumes that time to expiry. And if it's 3 months, you have like, I don't know, a quarter of the risk-free rate that is built into the price. That's why the S&P 500's future has a different price than the real S&P 500 ETF because of that expiry, or that the fact it's expiring a month from now. So you have some cost to it. Shrinking it
Mm.
down to every hour or every minute, even, or every block, means that you have this constant move back and forth. And the instantaneous demand for short or long gives you that funding rate. And if that 1 hour there's more shorts and you're long, then you have a negative funding rate, or positive funding rate. If it's more long than short, you have a negative funding rate. But that's just kind of how it works. You have to condense this into an hour. Perpetual options work a bit similarly, which is you sell an option in TradFi, you hold it till expire. Oh, you buy an option. Say you buy your bank, you want to buy some protection. You buy puts on the S&P 500. You buy it first day of the month. Then it expires the last Friday of the month. You buy it again next month. Expires. Maybe you make money, maybe you lose money, but you buy maybe a fraction out of the money always, or you have the delta as your entry point. But you just buy it every month, and then maybe it's every 3 months or every year. But you have this kind of cycling of expiring. No, okay, I will sell it, buy again, buy again, buy again. What Panoptic does is that we shrink this time not from 1 month to a day or an hour, but to every block. So what the protocol does effectively is that it's allowing you to buy that option again when it expires at the end block, and buy again, and buy again, and buy again. And if there's a lot of trading that happens during that one block, you pay a bit more. Volatility is higher. If there's no trading, maybe you pay zero, because you don't have this. The volatility is zero for that 12-second period. There's no trading. So that perpetual, it's a way to now say, imagine you have this ability to do the ability to do this in TradFi, where you sell zero DTEs every day, but then don't do it so that they expire the end of it, but they expire a month from now. So you roll forward that monthly option 1 day forward every day,
Mm.
and then you have this perpetual monthly option that is now allowing you to keep the same profile if you want, but then the close, when it closes at the end of the day, and when you open, there might be a different shift in price, and then that's going to be what, if your theta is up or down, this is how you pay and how much you get paid.
Yeah. Awesome. There's a little bit of truth in it.
I
Uh,
mean, the everything is an option. Could be either a perp or a lending position or a exotic option. To some extent, you can reconstruct this. Uh, yes, with real options, it's hard to reconstruct a expiring options using Panoptic's perpetual options, but the reverse is a bit easier to do.
yeah, it's only one implication for sure. Because also, like we are removing a lot of things. Like for instance, the expiration date. It's big part of the traditional options, so it's harder to like go from perpetual
And
to
exactly, and I think again, this is me kind of looking a few steps back. I think expiries are a lot of trouble, a lot of worry. Near expiry, most market makers, like, they don't even market make. It's so risky, and it doesn't have to be that Friday
yeah,
afternoon where everything is extremely dangerous for everyone. You don't have to kind of be subjected to this rolling that you have to happen every time. And yeah, I think that that is the nature of the beast, because this is how options have been traded forever. But yeah, I would say that if you look at it, I think no expiry is simpler. You have one less parameter to worry about. And as a market maker, you don't have an expiry kind of chain that is kind of always moving. It's like a static
mm,
one. But yeah,
for sure.
it's like
For
lending
sure.
protocols. I hate. I mean, I don't hate it, but if you borrow for a car, there's a term you pay enough per month, and then you lock that rate in. If you borrow on Aave, and maybe you buy a mention in the real world, but the key point is that you're floating the rate. You can pay whatever you want. If you don't pay, it accumulates. If you pay faster, that's it. And again, I think it's simpler. No need to read the fine print. There's no fine print. It's just you pay whatever rate it is for that block. And then if you pay it before you get liquidated, then yeah, we let you do whatever you want with that money.
Yeah, awesome. All right. Moving on to the next one. So this one has to do with futures. So perpetual options are just like perpetual futures, but with optionality.
I know. I think perpetual futures are used like options by a lot of traders, and this is one example I gave earlier, where the fact that you have 100x leverage and you can go 1% down and you lose and you get liquidated, and then 1% up you make 100x. Oh my
Yeah.
god. Oh, you make one, you double what it is. Oh my god. What people can do in DeFi, and I don't know if Binance will prevent you from doing this, but people are okay getting liquidated. They say, I'm going to put $100 in this sub account. That sub account will buy 100x perp. If I see the price going up, I have unlimited upside. Oh my god, this is great. If I have no, if the price goes down, I get liquidated. I lose my $100. That payoff is like you buy an option for $100 at expiry, whether it's in the money or not, out of the money, you lose what you paid, or you have the profit being dead. The in the money amount minus the amount you pay.
Yeah.
So that's a very similar way of dealing with options trading. Options like trading with perps, not being afraid of getting liquidated, refunding a different account. You cannot do this in TradFi. You can go and open 25 Robinhood accounts. But because you can do it in DeFi instead of just a different wallet, that's a new use case that people, without really knowing, maybe they are trading call options or put options that have limited downside because at some point you lose or you get liquidated. And the one thing that I can add is that this is also like an auto book. It's very permanent. You get liquidated once, it's done. If the price shoots up 5 minutes later, you've lost on that. But if you do it on the perpetual option level, you buy a call, you go back and forth 25 times. If at the end, when you close, you're in the money and make any in that kind of straight line, then you make money.
Yeah. I mean, there's a reason why at the beginning in the crypto space they started with options, then it didn't work, and then they introduced perps and it works, and then right after they introduced options and it worked, they saw the
Yeah,
similarities.
I mean, I don't know with the so BitMEX listed the perps, and this was, I don't know what caused this, and maybe I think this maybe, do you know if they started with options and this failed and they did
Yeah,
something
I
else?
did some research on that because I was curious, like about how they started, and
Interesting.
yeah, and I forgot the name of the company.
It
Give me a
was
second.
BitMEX that first created the perp option, but it was also like pros and somewhat in use in Asia in the 80s or something. But yeah, uh,
Yeah, so they started with options and it didn't work. They didn't have a lot of traction, and then they removed it, and I did perps,
interesting.
and yeah, and then they saw the similarities between perps and options because you can like there's many, as you said, as you explained it very well, and then it worked. And then from there, you just like the volume kept the trading
Yeah,
going.
I think also they had the Bitcoin being your collateral. That meant that you had
Yeah,
like the crypto native. I'm sure at the beginning, no one that was trading perps on BitMEX was investor or agreed did something. It was just Bitcoin whales that said, okay, let me have some fun. And yeah, it worked quite well.
yeah. All right. Next one. If you're bullish, just buy calls.
Maybe it's true. Again, a lot of what we see even at trade shows that it's very directional. You can buy calls, meaning you can get the right, not the obligation to buy the asset at a lower price than it is now. And a lot of folks buy call options as a way to kind of speculate or at least tap into some price action, or whatever Trump tweets. Someone says, "All right, I think it's going to go up." You can buy the stock or the underlying, or you can buy options on the stock, and that has some built-in leverage. And yeah, that's one way to make money, or at least one way to tap into that positive price move. The problem is that if you do this uh, consistently, you have people buying options, people selling options. The price of the option is pretty accurate, and unless it's a like COVID like crash where no one knows what's going on, and if this happens, everything will get much pricier. The bid ask will be very wide, and no one can trade. That's a way to get a go risk off. But if you trust that any opportunity is taking advantage of, and you're just a retail trader that wants to trade like I don't know $10,000 worth of options, you can assume that the price is pretty accurate. And if you look at either historically or on the TradFi side, is it is less of a positive EV. Even if you were to do a straddle, which is delta neutral, It's not directionality that's wrong, but it's the price that you pay. It's always a bit higher than what you would get on the uh, on a on the like fair value. You pay on the implied volatility. Implied is higher than realized. Most of the time, sometimes it's flip, but most of the time you pay a bit more for that upside. The seller gets compensated a bit more as well for that potential unlimited downside. And that means that in the long run, it's very hard to be successful either as a fund or a investment vehicle that does only options buying. The
Mm,
delta neutral trades are have no juice left in them by the time you do TradFi options.
mm,
There might be a lot of juice left in Panoptic because we're early, but the key point is that yes, being directional with buying options because you pay and you pay on this uncertain value, it is quite difficult.
mm.
So yeah, selling puts is still bullish. It's another
Another
way of
exact.
getting upside, but you get paid. So it's just a different trade off.
Yeah, for sure. All right, next one. Selling options is free money because most expire worthless.
Aha, no, that's right. There's like even subreddits called Theta Gang, or some people kind of have this opinion. And yes, nothing is free, nothing is easy money. Selling options is the probabilities kind of work pretty well. The
Mm,
why I like selling options so much is that you can estimate probabilities of being right or the probability of being wrong or kind of in that case out of the money or in the money. And if you're trusting either black shows or the model or what the market price is, you can have a trade which is going to be correct 95% of the time, or you can have one that is going to be correct 60% of the time or 10% of the time. The fact that you can choose a trade that has some probability means that the 10% of the time you'll make 10x on your investment. And if it's 95% of the time, you make 5% on your investment. You have this kind of trade off that exists. And if it's consistently a successful trade, you'll get paid a little bit. And if it's very inconsistent, you'll get paid, you lose a lot, but then you make a lot to compensate.
mm,
And that's typically a little bit almost zero sum. There's no winner or
mm.
buyer. Selling gives you the most fair price, and then you will get somewhat even if you do the exact same trade blindly, like some of these ETFs that do covered call selling.
Yeah.
You're not doing much. It still maybe dampens volatility, but it's not uh, like a sure way of making infinite money. The one caveat is that 95% of the time you're correct. For instance, with a trade, it could be like a 5 delta put that you sell, or iron condor, which is very wide.
Mm,
However, the 5% time of the time that it fails, then it can fail pretty badly. You can lose 20x what you made in a single trade and wipe out like months of profits. So it's all trade off. It's all about how you want to kind of live your life. Maybe with Rosalie, 60% success rate is actually pretty good. 50 is a bit
yeah.
more like coin toss, but 60, 70, 80% is a good trade off because you have wins, but these wins have sizable kind of profit. You don't make the max every time, but you make maybe a fraction of it, but you have a lot of successes. And then if you're careful, you can protect against these big losses, or if these big losses do happen, you don't have as much on the line and you cannot be worried as much.
Yeah, for sure. All right. Uh, yeah. Okay. My mind is like spiraling because I'm thinking about other things that you said. But yeah, I think I'm gonna write them because I have a few ideas and I don't want to
Oh,
like say
perfect.
too
Yeah,
much.
maybe
But
we'll do this
I'm
every
gonna
few weeks for sure.
write. Yeah. So next one. Perpetual options or just options in general are too complex for real adoption in DeFi.
I don't know. I would say that it's true to some extent. Options are difficult. We cannot sugarcoat it. It is to be successful, to be like sustainable.
Hmm.
It's not going to be an easy path forward.
But
Foremost.
what's easier, TradFi options or options
Oh,
in DeFi to adopt?
I mean, I don't know. Again, as I said, TradFi options have an expiry. There
Mm,
is like even if you want to sell an option or buy an option, sometimes you have to manage the bid ask spread. You have like a 5% very wide bid ask that means you lose kind of two and a half every time you trade. And
Mm.
it is now kind of not stacked against you, but unless it's very liquid on the underlying and you have a lot of expiries, you're stuck with some level of kind of predefined strategies, predefined strikes, low market volatility. So I would say that the this is me selling my own protocol, but yeah, it's probably simpler on Panoptic. The same way that with an AMM, you provide liquidity, you can sleep at night without having a bot running that manages your
Mm.
orders, manages your risk. You can wake up and the whole thing went down 15% and you lose, but then you don't have to be on top of it. And I would say that this is a good trade-off for me, especially I'm doing many things, but if I can watch my portfolio one or twice or a few times a day and manage when I need to, otherwise I kind of let it go, then that's a good deal. That's a good way to invest in DeFi. And the way that we do in Panoptic, you don't have to do short dated options or options that expire, meaning that at the end you have a lot of risk. You just do a monthly type of option where it's perpetually monthly, but you just manage this every few weeks. And most of the time, you can kind of walk away for a bit and come back, and it's working.
Mm.
And in DeFi, even in Deribit, actually, I looked the vast majority of the options traded are short dated, 1 day, 2 day, maybe a week at the most.
That's true.
Yeah,
Mm.
you've looked at the Deribit data too, and it's also why it says it's probably a little bit more on the speculative side, which is big bet. Oh, maybe Pectra update. Maybe there's going to be a big price move. Let me buy a weekly option, and that's kind of one way to trade. But if you look at the institutions, funds, banks that need to trade options, or it could be a structured product, which is kind of the underlying and a call option embedded into it. You don't want to manage this too much. You don't want to do it weekly. There's a trade off, maybe not yearly, but yeah, 2 months, maybe 1 month, 2 months, 3 months is where these
Mm.
traders. It's a hedge that you have also the ability to walk away. And as a buyer, you just buy it and say, okay, let's talk again in 2 months. But otherwise, in DeFi, it's a similar thing. You don't have to have the short dated. We make it a bit more difficult even to access. We don't want to have users get wrecked on short dated, especially on the sell side. So
Yeah.
that way we default to 1 week on base and Unichain because it's cheaper to manage, but defaulting to 1 month on mainnet because you can still choose 1 week, but the 1 month is a good trade off where you trade once every few weeks. You don't have to worry about management and gamma risk, which is kind of one of the things that the
Mm.
short, like narrow positions are subjected to.
Okay. Good answer. Next one. It's about Greeks. So the
Okay, maybe that's going to be the last one. I have a hard stop in 5 minutes, but
oh
yeah.
yeah,
Um,
sure. Okay. It's actually the 10th, so
okay,
we
we'll
might
end on a high note.
have.
Yeah, for sure.
But you don't need Greeks. Sorry, you don't need Greeks to understand DeFi options.
Yeah, like, it's one of those things where the Greeks are useful. There are tools, and if you don't have some basic understanding of it, meaning that you buy, oh, I'm going to buy 5% out of the money calls, or you don't have kind of the scaling that goes with volatility and the Greeks, you may not be consistent in your profit.
Mm.
And Delta and the Greeks helps you be a bit more consistent, I'd say. GameStop, like people bought the $1,000 strike call when the price was $200. This is like Delta in a normal situation, Delta of 0.001, very very small.
Yeah.
The key point is that it means that you'll be wrong 99.9% of the time and write a promo one. If you don't, and then I wouldn't use GameStop as a way to trade, but every underlying, you have the Greeks in front of you, helps you be more consistent, be uh, you scale your trade the same way every time. Whereas if you say the percent out of the money or the 7 0 DTE, but then in half day it's a different like story than at the beginning of the day, then you're less consistent, I'd say. So
Mm.
we try pretty hard to at least on the UI show the Greeks, show the data that people may need to do for creating options. It's as simple as on the options chain, we show what the delta is of that position. For those that want to use it, fine. Otherwise, you just kind of do the mental math as to where you're going to want. You cannot go. Um, yeah, you cannot learn chess without playing chess and understanding all the rules.
Yeah, for sure.
You cannot dumb
Definitely.
it down further. And when even then, it's very simple to get the rules, but being a good player has a lot more complexity. So again, it's a long journey for like being a successful investor, options trader. And I would say again, without the Greeks, it's still possible, but it's probably not going to be less consistent than if you are don't have to have PhD level understanding, but then there's a few things that you have to watch for.
Yeah, perfect. That's true. I mean, it all depends on your level of trading and in anything really. Yeah. So should we take a break here?
No, I think that's it. Yeah, I think this was great. Thanks a lot, Amy. Hopefully, those that are in the audience learned a lot too. I learned a lot myself about having to think about these questions. Uh, but yeah, this is great. I don't know if the we'll probably do clips or at least show some of that. But this is actually a very good idea you had there. So yeah, thanks, Amy. But I do have to run, but this is great, great idea, and then we'll probably keep doing
We're
this.
gonna
This
keep
is
doing this again.
all right. So thanks very much, everyone, and yeah, we'll see you. Oops, there we go. We'll see you on Friday back with Izzy and conversion therapy, and maybe Brennan as well for the best trades for the base competition. But yeah, on that note,
Perfect.